Hey, everybody. Welcome back to The Mortgage Athlete. It's been a little while, but I've got my good friend, Tom Reber, with Cross Country Mortgage. This is Tracy Hayes with Town Bank Mortgage now, and really looking forward to our conversation today as we do a little market update. So I'm going to kick off Tom with some questions that we obviously all of us are getting when we're having our coffees, our lunches, our interactions with our agents. You know, a lot of things about like, what's going on. So, Tom, can you give us, start off a little bit about what's going on today as far as mortgage, and obviously we're seeing the high interest rates causing obviously an effect locally, and obviously, I think more seriously nationally, as far as moving real estate.
Yeah, the market landscape is continuing to reshape the real estate market. There's a few more houses trickling in. You're seeing our inventory of homes to be purchased and offered up for sale has continued to grow. And the absorption rate is still there to take those off the market with regards to qualified home buyers. However, the challenge is, how can we take what happened a short 2 years ago, and payments have gone up 16, 70% with regards to qualification opportunity and the amount that the payment will be compared to what it was. The affordability index has continued to be stressed and makes the bar much higher. So the bottom line is the velocity of money is still flowing. We just have to find creative ways to make transactions come together for the right reasons.
And while you were saying that, I was thinking about, everyone's kind of putting out there now this 100% FHA, which basically they're giving them that small second. The challenge, however, in that whole situation is affordability. The wages haven't increased enough to counteract. Well, obviously, at least in our, we can only really talk about Northeast Florida as far as we're seeing. Affordable housing is still obviously a challenge.
Yeah.
Yeah.
So the good news is the vibrations on the street is the financial sector, aka private, smaller builders are going after building more affordable houses, trying to fill in that gap. And there's a race to the opportunity zones, which is also state and local government backed areas to try to promote growth. And you're starting to see those things fill in, but the $250,000 purchase price to $350,000, that bar and that location is a great spot for people to buy houses because the affordability index gets easier for them. You don't have to have $114,000 combined income to qualify for a median income home. You get back down to the $75,000 income range to qualify, which is a big win. And that gap is being filled in. But to your point, finding those homes is tough, but the refurbishing of neighborhoods, the resurrecting of neighborhoods that have gone down, that are going through the cycle, is coming back in big time. So renovation lending, rehab, home equity lines of credit, those things are filling in the gaps as well as you go back into the older neighborhoods and revitalizing them.
That brings up, again, yeah, I was thinking the renovation loan, and you led right into that. And our real estate friends that may be watching this, if you are not confident and you are working with some of these buyers that really need to be in that sub $400,000 area, and you're not comfortable with how to set somebody up to say, hey, we're in the price point, but obviously it needs some TLC. Let's do a renovation loan. Obviously you do them, I do them. We gladly will come out and sit down with you individually or talk to your team or lunch and learn with your brokerage and talk about renovation lending. But I think you're right. These first-time home buyers, it's actually an opportunity to go in and revitalize some of these areas.
Yeah, there's some of the zip codes around town, which some of those are opportunity zones, but the zip codes, I grew up on the west side of Jacksonville, the 32210, the 32244, the 32205. Those neighborhoods and surrounding areas are going through the revitalization. There's a lot of 3-bedroom, 2-bath houses, 1,200, 1,400 square feet that need $30,000, $40,000 worth of work. And you can bring them back and refresh them into a wonderful, good home to live in, make it solid and bring it up to speed and recalibrate the electric, recalibrate the roof, get the fixtures in place and go through and do a solid refurbishing of the home and get another 30, 40 years worth of life out of it. So a lot of that needs to happen.
Yeah. I mean, would you agree from a wealth creation, that price point of home, should there be some sort of collapse or value update, if you want to call it that, that might happen on the $800,000 or $900,000 home, $700,000 home, but that $250,000, $300,000 home is only going to go up. Should it be kept up?
Without a doubt. And if you take the 32210 on the west side of Jacksonville, and let's say a house over there is $150,000 and it needs work, and that work, most buyers kind of turn their nose up at it, or it's thought of being unlivable, when really it needs somebody to come in and do a feasibility study, or give it a contractor to come in and look at it and say, what would it take to get this house into a thumbs up, safe and habitable living position? They may find out it's only 30 grand to really polish it up and make the functionality real and lasting, and give it. The insurance piece is another thing today that'll make it the home insurable. And of course, then it makes it attractive for financing. And you can bake that into cake, FHA, VA, and conventional. All three have renovation opportunities today, to your point, Tracy.
Yep, 100%. So obviously, we sitting down with agents this week and having, obviously, the common question, which is always asked of any mortgage person, where do you see the rates are? Obviously, we're at the highest rates you can see in the news since 2000. Currently right now, many in the springtime, some of the great experts said, oh no, we're going to, the rates are going to soften. We'll probably see 5% last, 3 or 4 months during the summertime, which obviously did not happen. What is your analysis? Because I know, as part of the Mortgage Bankers Association and stuff, you really dig into the data on some of this stuff. Why are we seeing, these rates? How can the agents that are watching, or maybe other mortgage loan officers, explain this intelligently, or why we're seeing the current interest rates where they're at right now?
Well, it's a very complex question, Tracy.
Yes, it was.
It's a very complex
well,
question.
You're the best guy in town to answer it. I know that.
Well, this right here is a mortgage calculator from 1989. This is how we used to calculate payments back in the day.
You're still carrying that in your back pocket?
Carried with me like a badge of honor due to the fact that simplicity rules. So my answer to you, Tracy, to keep it simple, is we have had inflation run rampant for the past 2 years, obviously. And we've also seen the national debt go to, overnight, we're at $33 trillion. And so the more we borrow, we have to somewhat go out and manufacture more money to pay our debt, or make more money, or quite frankly, slow down the spending of what we do to support. So it's this unique cycle we're in. And we're literally, you mentioned some data. I would probably say that we're back to 1992 with regards to dynamics of real estate and mortgage. And I say 92, and it's a long time ago, 30 years ago, whatever. And rates are what they are. The velocity money is what they are. So two things are happening right now. One, house values are at all-time high, but it's also the inflation baked into it. So what a house was worth in 1992 for $140,000 in theory is now $440,000 based on the inflation, based on the debt of the United States going forward. And again, I'm not a super expert, but what does that mean for rates? It's going to be a challenge. And I don't see rates going down anytime soon at this point, because we had a couple opportunities to make it work. And right now we have another challenge coming up in Thanksgiving. We're going to be faced with the government shutting down because we can't come up with a new debt deal. So that's also going to play into this. But we're connected globally like we've never been before. And you look back historically. Mm-hmm. And we've had this where the inflation rate is higher than the 10-year treasury rate, which has only happened 4 times in the past 40 years. Well, this is a fact that is out there that what's going to snap, because the first time it happened was 9/11 happened. The next time it happened, we had the housing bubble. The third time it happened, we had COVID. Now this is the 4th time it's happened in 40 years. What's going to snap? I don't know. But economically, rates are where they are. The velocity of money is what it is. And as I like to say, so what, now what? Pay now, save later. Rates will come back. This is a cycle. But what we've learned from COVID is we're living in dog years. Every month is 7 months. Every year is 7 years. So the velocity of change is happening faster than we've ever seen it, by far.
I had a question the other day. Actually, my wife asked it. We were talking about ARMs, right? So,
Yep.
Hey, the rates are high on the long-term money. Why don't we just get an ARM so we can buy some time until the rates come back down?
Yep.
But we've got an inverted yield curve.
Yes.
And, you get asked, but I mean, in your great knowledge, I mean, why is short-term money more expensive than the long-term money right now?
That's because there's no valuation of it. They think it's not going to be around. It's not exciting. Now the private sector will step in. You'll have banks and credit unions will start taking some significant flyers and say, hey, look, if we can take our portfolio and make 5.5% on it, we'll do a 5-1 ARM or do something like that. So you'll see that backfilling in as we get further and further. The challenge is, Tracy, is the servicing valuations. As we've all known in the past, a loan would stay on the books for 5 to 7 years. And the servicing companies, whether the mortgage company or the servicing company, would pay a premium for that for collecting payments going forward. That premium payment now has gone down to nickels and dimes compared to dollars, and it's made a significant impact. So 2 good things from that. Number one, when the rates do start trending down, the velocity of money will go faster because the lower the rates go, if we're at, let's say, I can't hardly say it, but 8% today, and we get to 7% and we get to 6 3/4, it's going to push the rates down lower faster because you're going to get more servicing valuation because they're not going to refinance the next 2 years. So that's my point about the velocity of money. Pay now, save later. Buy house today where the location is, save later. The old saying was date the rate, marry the house. It means the same thing, but you're going to pay now what the market is yielding. And then potentially in the future, you can capitalize when rates go down. So I'm telling people, in my opinion, don't throw your chunk of change into the house. Use other people's money, put 5% down or something like that instead of 25% down. Right. Go make 5 1/4 on a money market account. And then when the market evolves and moves, take that liquidity and then potentially put it back in the house. Because the lesson is, Tracy, your house is going to appreciate from 0 to 5% to 7%, whether you put 25% in that house or not. So why tie it up and make it pixie dust where you can't get it and then keep it liquid? Because today rates are high. Take advantage of the rates being high in your investment accounts, money markets, CDs, things like that.
And another thing, obviously, we're talking about, and we've been educating our agents on as well, is you're trying to get some of these people off the fence to go and make the investment because the value of the property is going to go up. Because we see when that rate does drop, go to 7 or 6.5, we're going to see a rush. We already have a high demand here in Northeast Florida to begin with. But we're going to see that rush again of people going, oh, the rates drop, I better get in the market now, because they are sitting on the sideline currently. And do you see that driving up the value of the home just because of that factor?
Yes and no. I'm going to give you a complicated answer to that. So the good news is there's homes coming back to the market. Yay. The bad news is once the velocity of money picks up and goes faster and we get, a little bit more mentally attractive rates, you're going to lose inventory like that. And I don't know if we're going to be able to backfill inventory out there for people to buy because technically today, the people that are in houses, and you can look at the data, if you have a house that's been around for 5 years, they're at, 3 1/4, they're at 3.5. Why would they technically sell? It's bringing out an aspect of 92. That I spoke of earlier. That aspect is contract to deeds, seller held financing, assumability of loans. It's bringing out the creativity that most of the people in our industry today do not have experience with or knowledge of. So the resurrection of the 1992, the 93, 94 days of how financing was working back then, it's very eerily similar to today. And people are using Google and DuckDuckGo and other things to figure out what's a deed for contracted. What does that mean? Well, it's an opportunity. I was on the phone with a buyer the other day, and I said, you're in a challenging spot, but if you're going to put 50% down, and quite frankly, you're in between jobs and moving from a different state, I would raise my hand and ask the seller if they'd be willing to hold a seller second or hold a seller mortgage on this deal, because you're putting 50% down. You're getting reestablished in this market. If I was a seller, I would probably entertain that because I can have my cake and eat it too. And so we're just trying to find ways while we're in this to manufacture opportunities for the right reasons to continue to support the real estate, the loan officers, and all parts in between, because it's going to take a village for us to survive this lone winter as we're in today.
Right. I want to just change pace a second and talk about something I've learned a little bit here in the last couple of weeks. My new leadership here in Eileen is so brilliant, and their experience is much like yours in the a lot of the banking side of things. The federal government's come down a lot on, and you can correct me with the proper terminology, their deposits to what they're holding. In other words, a lot of the banks, and we know the names, would do a lot of portfolio lending, or like the doctor loan. That's not a loan that Fannie Mae and Freddie Mac does, where they got a secondary market to sell that to. And now with the increased pressure from the CFPB, the feds, on the banks because of the recent, last year's, or was that earlier this year, the failure out in Silicon Valley.
Yeah, earlier this year.
They really weren't doing the checkup that they were supposed to be doing, and they got caught with their pants down in Silicon, that bank going under with a couple others. How is that affecting the products that we're able to offer because of that pressure from that?
It's now become, instead of it's a non-QM loan, qualified mortgage. It's a non-qualified mortgage. It doesn't meet the guidelines of a standard mortgage required by the government to show the ability to repay. Mm-hmm. So when you lend money like that from a banking perspective, it's what I like to say, a 3-for-1 lend now. So if you're doing a doctor loan at $1 million with no money down, you're actually going to have to secure $2 million behind that for it to potentially go as a security against default. That's crazy high bar, but that's the world we live in today. And that Basel III has changed the landscape for a lot of the large $100 billion banks or larger, and they're having to rethink why they're doing portfolio lending, because it's so expensive, because of the security requirements after they lend the money. It's because it's pretty much dead money to them. They have to just keep it in security and to keep it balanced, which means every time they lend that money out, they've got to have $3 behind it secured to offset that potential loss. So it's making people think long and hard. Not everybody's affected by the same rules. And the private sector is going to figure that out. But that velocity of jumbo money to those specialty products is slowed way down. And it'll probably continue to slow down. And then, like I said, the private sector will step in. And you're starting to see that now, where you're having companies come into the bank statement loans, the non-traditional income analysis, step in and provide very competitive rates, because they're like, what a margin. I mean, we're using private money and we're lending private money, and we don't have to go by these rules and laws. We're going to be and set our own rules and be aggressive with it to a point of making sure we're covered with regards to the collateral. So it'll be interesting how things continue to evolve, but banks are in a unique spot where they're asking themselves why we're lending at this space. We want to take care of our customers. We want to take care of our members or whoever they may call. But at the end of the day, they're worried about the liquidity.
I have a few more topics that I had put down, but I've been running the floor here. Do you have anything that you thought would be great for our listeners to learn from today?
Yeah, I think what I'm sharing with people is talk to your loan partner. Having meaningful conversation of what you're trying to accomplish. The stock value for real estate agents, the stock value of loan professionals, and quite frankly, the support staff's at all-time high. The pretenders are going to get out of this business. The players are going to sink their teeth in and have a meaningful conversation. In a fun way, you've heard me say this for years. I interview people for a living. What's your name? What's your sign? Where are you from? Mm-hmm. What that equals: income, asset, collateral. But the reason why I say interview people is you have 8 seconds. They swipe and lose focus on what you're trying to accomplish. You need to have a meaningful conversation for the right reasons with your referral partners, with your customers, and understand the logic of why you're getting this done for the right reasons. And you can actually craft a transaction and win instead of saying, oh, that's not going to work. Dig a little deeper, dig your teeth into it and figure out, actually maybe read the guidelines, look for opportunities. The biggest game changer coming forward on November 18th, Tracy, and you've heard this, we're going to take, for the first time, Fannie Mae has finally backed off a credit risk decision and going to do 2 to 4 unit properties with 5% down for primary residence. So literally, Tracy, you can buy a house that's a duplex and rent the other side out and self-medicate the payment. First time since the early 90s. That's why I keep saying 1992. So anyway, my point is this: you can buy a quadruplex, live in one unit and rent out the other 3 and self-medicate the transaction going forward. Think about that. Primary resident purchase, 5% down, all of a sudden is in play. And now we can go back to taking an individual and playing the game of Monopoly for the right reasons. And they can rent out the other 3 sides, as well as buy their primary residence, get primary pricing, and only put 5% down compared to the previous, which would be, you can do it as a primary residence, but you'd have to put 25% down to buy a 4-plex. Think about that.
What do I obviously I hear that here in Northeast Florida, we know, I mean, really the only places you're going to find duplex, triplex, quadplex.
Yep.
And for those listening, most of the lenders are only going to lend on 1 to 4 units, right?
Right.
You go to specialty lending, or you want a apartment complex or something. So 1 to 4 units. And that sounds all great. We hear it on the a lot of podcasts, like, hey, if you want to, grow your wealth while you're young, buy a.
Yeah.
But these properties are obviously under high demand. But like here in Northeast Florida, the only place you really see multi-family units is in the older sections of town. So it's very limited as far as, inventory and any really good investors jumping on them right away.
Well, the velocity of investment purchases has slowed way down, number one. Number two, you're seeing a lot of your large, let's say, homeowners groups, the private equity groups are starting to slowly jettison property back into the market. But you mentioned some of the key denominator, those older homes that are duplexes and quadruplexes, your home builders, I've been talking to a few of my friends that are home builders, are looking significantly how to do multifamily new construction. So you're going to see this come out because you heard me mention opportunity zones, density of population, build in those areas. You get tax breaks for putting houses. A lot of those are looking at higher density homes, and they get more subsidy from others, the city, the county, even the state, to build in these opportunity zones, especially if it's high density housing, such as duplexes, quadruplexes, and quite frankly, 40 unit apartment complexes are starting to pop up, where you're seeing some significant incentives to do that. Like I said, the private sector is going to backfill in, the builders are going to backfill in, and we're going to see this cycle go back in a lot of ways. Because like you said, you hit the nail on the head. Older properties are typically duplexes and triplexes and quadruplexes. You're starting to see those pop up on new construction now.
Yeah, no, I definitely would, having been on the Affordable Housing Advisory Committee here in the county for, I served a 4-year term, and it gets very frustrating because it is hurting our, those people that are working in the restaurants. Those are people working in the grocery stores, those service type businesses where, it's not a huge salary or whatever. They're in transition in life, but their affordability to live and have to travel so far just to come in to work, it just doesn't it's not feasible. And we do need these multifamily units.
One other piece that I'd share is there's an aspect, and people have read about this as well, because it's been in the news a lot of lately, but I call it the Bank of Mom and Dad, the family supported down payment assistance program, not the state, not the county, not the national stuff, the federal government. This is the Bank of Mom and Dad, where literally young people are turning to their parents. Their parents are having to make decisions and say, you know what, if I'm going to take some of the family wealth, why would I not invest into my kids into real estate and help them with buying homes? So the conversation is no longer, hey, I'm sorry, I'm not going to give my kid a down payment, to, you know what, I am going to help our adult children buy houses to help keep the family moving in the right direction. They're having
Right.
these real conversations for the first time in a long time where, it makes perfect sense. If I'm going to donate, in theory, $40,000 to my child to buy a house, why wouldn't I do that?
Right.
The number one reason why they would not was the initial response of, if my gift is going to be taxed. Wrong. It's not going to be taxed. You have to put it under your lifetime exemption. It's one extra form your CPA or your tax provider has to do, and you are not taxed on 40,000 because technically the gift limit per year is like $17,000. Don't necessarily quote me on that, but
Yep.
you can do a lifetime exemption on your tax or your gift to your child of 200,000, 100,000, and not be taxed for the one form that has to be filled out by your tax provider. Why? Because your lifetime exemption is over $12 million plus. You've got a lot of money to give away before you even thought about being taxed on it.
Right.
Just saying. So the bank mom and
100%.
dad can participate without recourse for the right reasons. And guess what? They are in tune. And also one other piece is the non-occupant co-borrower is alive and well. Tracy and you and your wife would make co-sign for your child's house for the right reasons as a non-occupant co-borrower. They get to homestead the property. They get primary resident pricing and power, but yet they get to buy what they want. And you guys are on the team with them. Again, like I said, the bank of mom and dad, the family aspect needs to be looked at it in a different narrative than it was maybe 5-10 years ago.
Well, and then on the other end of that scale is the auxiliary, unit on the existing
the
property,
ADU.
the mother-in-law
auxiliary
suite.
dwelling unit for sure.
Yeah.
Because now, I mean, all the I don't know all the Gen Zs, the Gen X. I don't know the exact years, but I can tell you my lane. My parents are of age, and they're recycling back around where multi-generational homes, where you have a borderline ADU unit, and now you've got some exemptions today where if you have enough space in your backyard, you can build a unit in the backyard and have it added to your house. And most counties and municipalities will allow that and zone it for that to take care of your parents or, high need children.
Yeah. Yeah, exactly. I want to, we're coming up right here in 30 minutes. I want, for our loan officers that are out there right now, Tom's a great resource. I know in my transition in the last month, his knowledge, if you are with a company, because we are seeing different companies imploding right now, not giving you the support. They may have taken away all their support or whatever they were doing for you and why you liked working there. And now all of a sudden things are starting to change. There aren't as many processors. There aren't many underwriters. It's taking longer, or marketing dollars, whatever it may be that you may be looking to move. Tom is a great resource. Feel free to contact myself, because I did a lot of due diligence over the last 3 or 4 months and choosing to obviously go newly here to Town Bank Mortgage. And, things are going on there. Reach out to your fellow loan officers. I would highly recommend, before jumping a ship, just to get some feedback from what is around, because I have made the mistake, kept things on the low profile in the past, moved, and then found out all the bad things about the person I moved to. So you don't want to end up doing that, but reach out, because it is a time, I think, of change. Would you agree, Tom, that there are people moving? And as the new year comes around, unfortunately, a lot of our loan officers that came into the business the last 3 years, a lot of them may not be here.
Well, there's going to be an attrition rate. The pain point is the pain point. And, there's no longer just this plethora of loan opportunities floating around and you can pick up the scraps. Every opportunity has to be vetted. Every transaction partnership, it's easy to get customers. It's precious to keep them. And then when you run across customers that are in that circle, they're still struggling. And how you work with those. But not every mortgage company is made the same. The speed of business, the velocity of business. I was just looking at my numbers for October, and I've never said this number before, but 20 days from app to funding is normal. 20 days. What the heck? 3 years ago, I'd have said there's no way in heck that you can maintain your total pipeline turning in 20 days. Mm-hmm. But we're turning pipelines in 20 days. It's just saying the velocity and the speed of business is at an all-time high, and it's not going any slower. and you have to have support. You have to have experience and knowledge. Pull the audience to a 50-50, phone a friend. If you're not willing to do those three things, you're going to struggle, and you're going to be doing a different type of career soon and yes, it takes a village. I'm easy to find. My name's Tom Reber. He's Tracy Hayes. We're not hard. Call us. I'll give you a cup of time.
This will be on your LinkedIn. I'm going to share the link over to your LinkedIn page because I know you like LinkedIn. I'm all over Facebook, so either one of us can be reached.
Yeah, it's easy, and I called a cup of Tom. Call me. We talk, have a meaningful conversation, and transparency. And hey, drink water out of the fire hose and pick up a nugget or two and find a win.
Excellent. Tom, I appreciate you. We're right here at 30 minutes. Keep it to that. I know you've got some business to take care of this afternoon. Good luck with that. It's a beautiful day. Beautiful day out there. It cooled off. A little hot Halloween last night, and all of a sudden this morning we woke up, it's a different temperature.
Yeah, I got a little jacket action today.
Oh, yeah. Appreciate you, Tom. And,
appreciate you, Tracy. It's good times.
We'll keep these regular going and give you good information that we can provide the value out to our referral partners.